Hello, everyone, and welcome to the Nerd Day celebration. We are very happy to have you all here and super excited to have our guests today. We've got returning champion Daniel Crosby, behavioral finance expert, author of many excellent books, including the most recent one, Soul of Wealth, host of the fantastic podcast Standard Deviations, and all around excellent guy. Cynthia Murphy she's the investment strategist at Vetify, was the head of research at ETF Think Tank, and journalist and editor ETF.com, and just basically expert in all things ETFs, and has written about them and been part of that world forever. And of course, Phil Toews, who's devoted his career to helping investors lower risk in their portfolios and guide them through the balance between their behavioral and financial needs. And also recent author of The Behavioral Portfolio, coming out in March on the same label as Daniel's books. Label, not quite the right word, more record industry, but you know what I mean. Okay, so super excited to be here. I can't wait to talk to you all about this. We're going to talk about our worst investment ideas from last year, and maybe what those mean going forward, and maybe even some that are happening right now. But Phil, why have this holiday at all?
Yeah, so our former national sales manager, Dan Coleman, came up with the concept of creating a holiday called National Investment Risk Management Day, which is super unwieldy and multisyllabic, way too much so. And we wrote he wrote a really boring press release, and then I noodled with it, and brought in a ton of irreverence. And what it has come to be is a way that once a year we can stop and reflect on what is happening. One of the most surprising things that I see happening as bubbles inflate and trends emerge and become crazy is initially you've got the part-time Uber drivers coming up with an idea, but what's most surprising to me sometimes is when things move up enough that they have enough of a long-term return that institutions get on board. And so so it's one thing if just a guy does it, but it's another thing if BlackRock does it and creates access to it, and everyone does it. And so over and over again, we see things like the housing crisis and CLOs inflate, and everyone gets on board and it blows up. So this is a day to check in. I wanted to frame this by bringing up another image. Created something called I created a word called the corona bias. And I don't know if this will help frame the conversation, but what this refers to is inside this first circle are things that have happened historically that advisors prepare for when they think about the markets, because they've been recent enough. Outside of that first circle and inside the second circle are things that have happened historically, but they're long enough ago, like the Great Depression, that we don't prepare for. What I think is really fascinating, and maybe we can include in our conversation today, is things outside that second circle, which I frame as things that haven't happened historically, but could happen, and emergent things that are going on in the macroeconomy that could impact us, and we might need to plan for, but they've never occurred historically. So I think that all this stuff we can talk about, and Evan, I'll hand it back to you now.
Yeah, so I think something that's really interesting about National Investment Risk Day, NIRD, is that we're going to look at these issues, these unreasonable investments, or what we see now in hindsight as unreasonable investments, and maybe we saw them as they were happening as well, and then look at where we are now. What do these say about the market we're in? What do these say about the market going forward? Where we are in the equity and debt cycles? Is there anything that we need to look at in ourselves for our current situation and the greater investment community? So we're going to go with each of you in your three zaniest investments from last year and today, and talk about them and have a good time with those. And Daniel, as the returning champion, I want to start with you, please.
Okay, do I share all three or just one?
Share all three, and then we're gonna tear you to shreds.
Okay, beautiful. So I'm ready. So my first has to be the return of the crypto meme coin resurgence, right? We've seen this as recently as this week with the various coins around the new president, with the gentleman who gave the prayer at the inauguration, immediately jumping off stage after communing with God, and then launching his own coin, to help build the kingdom. We've got Andrew Tate launching Daddy Coin and then selling it. We've got of course Fart Coin, which achieved a $2.5 billion market cap. At one point, we've got Dog with Hat, which was up 4,000% in just a couple of weeks. I mean, this to me is pure, unadulterated, greater fool investing. There's no pretense of value. I mean, nobody's even pretending that there's any utility here beyond number go up. And yet we just see people continuing to gravitate towards these because of the narrative around a certain small subset of people who have gotten rich with these things. Of course, many, many more people have gotten broken by these sort of shady instruments. But to me, the crypto meme coin resurgence has to be right at the top of the list. Right behind that, I would say betting on investors with awful track records. Yesterday we saw Masa-san come out and be really very much the face of AI, and there's some disputation around the number among prominent people in the space, but he is holding out that he's going to be bringing half a trillion dollars in investment to AI. This is a guy who at one time had 5% of NVIDIA and sold it to pile those proceeds into WeWork, which promptly went bankrupt. I mean, NVIDIA, the greatest success story of the last, 5 to 10 years, and he was right there and didn't see it, and yet now he's the face of AI going forward. Speaking of WeWork, a conspicuous con that was really mismanaged. Adam Neumann was able to raise $350 million now with a slide deck that still seems like vaporware, still has no product behind it. This is the guy who built WeWork, famously conned people out of money for that. We even saw a sort of Elizabeth Holmes 2.0 thing where many of the prominent folks involved with Theranos were able to spin out and raise a bunch of money. And I like Phil's point. It's not just mom and pop retail investors that are getting swindled. It's not just sort of uneducated folks who are getting swindled here. Andreessen Horowitz invested $350 million in Adam Neumann's startup. These are sophisticated, intelligent, well-resourced investors who are going out on the risk spectrum to places where you just wouldn't really see institutional money going. And then my last one, again, to sort of Phil's broader point, is the zero-day expiration options craze. This accounted for 40% of all options volume on the S&P, and this is effectively, I mean, at 0 day, I mean, it's effectively all noise. And you've got 40% of options volume going to something that is literally just a roll of the dice. So you're seeing big, formal, institutional acceptance of very risky stuff.
So you're talking about the institutionalization of speculation.
Yes.
Now, is it possible that any of it that is, we are curmudgeons and we're get off my lawning this new form of investment that just moves faster than we do?
Yeah, I'm certainly very lame. So I'm open to that possibility. But I think it's a voting machine, weighing machine consideration. And I think there's plenty of folks who would say, well, you just, Daniel, you just missed Fartcoin and you're just jealous, which is, to be honest, partially true. And so I do think that, there's a bit of that. But I also think that, the market can stay irrational for a lot longer than people think. And I think that's what we're seeing here is best practices, historical best practices sort of falling to the wayside and these get rich quick schemes coming front and center. So maybe we're being too staid or too boring, but I do think that in the long run, these weighing machine type principles will rise again to the top.
Can I ask? I have a question. Like it's like along those same lines, which is that because Evan, your point is so valid. We all feel like schmucks, right? I mean, I was looking at when at Bitcoin at 42,000 when the ETFs were launched, and it just seemed so obvious that increased access to Bitcoin was going to move it higher. And so, had any of us taken our net worth and put it into Bitcoin ETFs, then with Bitcoin up around 110,000, it would have been more than doubling your money. So you have this amazing sense of not participating in everything that's going on, even before you get to some of the crazy stuff like that. And it's already almost like forces you in or forces you to want to play a little bit. But I'm kind of curious, like, so is this really just a legalized form of a Ponzi scheme? Because the thing that's missing in a Ponzi scheme, it's deceit, right? The guy that's raising the money is saying there's this wonderful forming investment behind this, and it's going to pay out. But isn't this really the same thing, but just with full transparency? Like that's all it is, really? I'm just.
Yeah, I think yes, but I also don't. I would push back against the full transparency a bit, because every time you see one of these crypto meme coins, for instance, get rugged, right? They get the rug pulled out from under them. You see honest, hardworking people who seem legitimately confused by this. And so even though in some ways there is no pretense of value, and I think in some cases the creators and the distributors of these coins have been very upfront that this is a meme and sort of not much else, I still don't know that the average person on the ground understands how this works. And a lot of times they are putting faith in a creator or a public personality for whom they may have a lot of reverence or a lot of respect, and they feel like what's being done is duplicitous, that it's shady, and I think it is those things. I think these people are trading on their name, they're trading on trust, and so I feel like the average consumer still doesn't have a full understanding of how dangerous these things are, which is why we have this holiday.
I think also, and for those people who are subject to getting rugged and who lose money, they likely blame themselves for getting in at the wrong time, rather than the fact that this was organized to do that. Yeah. Cynthia, I have a question for you. You look like you're about to say something, so why don't you say it, and then I'll ask my question.
Yeah, no, what I was going to say is, the flip side of that is just the story of access. So, the market is supposed to be open to everybody. So it's, is it the market's job to be out there and making sure you only get in on the things you can handle? Or is it your job to really understand risk, which is why I love today's holiday, is just really, you have to take a minute to understand the risk. What I think is interesting is if you think about the ETF space, which is the lane where I swim in, putting these kinds of super speculative investments within an ETF wrapper in a way almost legitimizes the approach, I think, to a lot of people on the street. It just becomes like, well, if there's an ETF for that, and I trust that ETF as an investment vehicle that I can put in my brokerage account, it kind of, broadens that reach in a way that may be kind of dangerous to people who don't understand. So while I love this broadening of access, which I think has grown the speculation too, it also opens a door to risk to people that may not have access to that risk. They may not have set up an account on an exchange to buy crypto directly, but they may be more inclined to do that, through an ETF. But I gotta say, I was looking yesterday, just reading some commentary on, why do people just buy this stuff? And if you go on all the channels and you're in your X and Reddit and all the conversation panels, eventually I hit this guy, and his quote really hit me, because his point was FOMO feels worse than being left holding the bag. And I thought that was fascinating about just human behavior. We talk in our world, we talk so much about aversion to loss as being the core principle of how we invest. And that's why we diversify, and, capital growth is great, but losing feels much worse. And here, this guy just throws this whole thing on its head and says, actually, not participating and missing out is the worst. So they rather lose money than not participate. And if you think about a generation feeling that way, assuming this is even generational, it really kind of explains why these crazes just seem to just grow.
I think you made a really interesting point. We have certain investments that are potentially less risky that you need to be an accredited investor to invest in. Yet having a cell phone or internet access, I guess, is the only requirement for investing in these things that are far riskier than I think some of the things that one needs to be an accredited investor to invest in. And yes, like those ETFs have been cleared by the SEC. They have been anointed as essentially safe investments by our federal government. So that's interesting. Cynthia, do you think that part of the reason that there are these speculative investments that are front and center in the news is that we've had such an amazing run in markets, and there's just a lot of money sloshing around that people are playing with?
Yeah, I think we're all a little addicted to growth. We've seen things go up and go up exponentially, and sometimes defying things like fundamentals, that it's kind of hard to all of a sudden take a step back and be like, maybe I should just be cautious. We just kind of got addicted to it. We expect it. We expect gains despite gains, and just keep going. So I think that's one thing. I've wondered for a while whether, post-pandemic, for a lot of people, the pandemic meant two things. One, extra money in your pocket, and two, working from home. So more flexibility, perhaps, in your schedule. And some of these things kind of became permanent. So I wonder if that just opened a time where folks have more time and maybe some, more resources. They're not commuting, they're not eating out as much, maybe like if you think of a long tail of the post-pandemic. And so they just find themselves with more time in front of a computer, and, maybe investing is a game to a lot of them. Maybe it's entertainment. I don't know. So I wonder if there's actually just kind of an environment that was artificially created due to the pandemic that just kind of became ingrained in people, how people manage time and manage their money.
Yeah. All right. So you want to take us through your ETF, your excellent ETF glasses you've got on?
So, the glasses is because the eyesight is going downhill fast. So yeah, good and bad there. But on the ETF space, all the stuff with the crypto has been really interesting to watch. The amount of money that has gone there so quickly, as we all know, last year was the first time we had spot Bitcoin ETF access. Then we got Ethereum, and there's a million new filings for all sorts of different things coming. The money has gone quickly there. There's already over $100 billion in that category. It's almost the same amount of money in that there's in commodities ETFs today, which is huge. So that's obviously something we watch. I think for me personally, to show my age, it took me a long time to be kind of comfortable with the Bitcoin story and dab into that world. So all this other stuff, and how many years has Bitcoin been around? Like more than a decade. So I think it's going to take me a long time to get into all the other stuff, the Solanas and, all these other, to even not talk about all the meme coin stuff. But we have seen a lot of money go into there. Do people know what they're doing? we can only hope. I think with the Bitcoin space, I'm not as concerned. It feels kind of, we've discussed a lot about custody. We've discussed a lot about trading. The other stuff, I mean, there's just a bunch of filings that hit last week for some, some really, really crazy ETFs are going to be coming to the market, all trying to capitalize in this meme coin craze. I would just say beware. It's not my cup of tea. The other thing that I think has been really interesting in the ETF space is that single stock leverage stuff. It's kind of, if you think about the ETF, the history of the ETF wrapper as being the vehicle of diversification and, broad exposure within a single ticker, all of a sudden we're like a 180 and we're talking about one single stock, leverage on that stock through an ETF wrapper. So I think just that movement is kind of fascinating. And the amount of money chasing that, I think that's really risky stuff. And it feels very much, part of the whole get rich quick, which it talks to me about our addiction to big returns, outsized returns and growth. It's a space that keeps growing. Several providers, so they have versions of these ETFs, which is whether it's your 2x NVIDIA, 3x Tesla, it's just all over the place. A lot of money's chasing that, and I worry about that because, as we know, it's a daily compounding effect. When the stock turns, that those losses compound very quickly. So it's a space that I watch, and it makes me worried a little bit. And finally, it's not really risky, but I think it's kind of an interesting concept, which is just your protection ETFs, downside protections, your buffer strategy. So it's actually your anti-risk play. But I worry that, at least in the advisory channel, there's a risk there that may be kind of misunderstood. If you think about how these buffered type of ETFs work, they reset annually. But every single day, that range of participation you get changes. So whether you're going to get your 10% upside and your 10% downside, that band of performance changes every day as the market moves. For an advisor, they put, it resets, let's say you get the January fund, and it resets on that day, you put a client account for 5% in that fund. The next day, you're going to put a different client in that kind of strategy. And you just go with that 5% allocation because in your model, that's the way to protect an equity sleeve. Well, that performance for that client is going to be different from client one. And the third client, the fourth client, everybody's going to have a completely different experience because these buffers change every day. So I think the adoption of those products has been very big. I'm just not sure that it's fully understood that the risks will be different per day. But the good news is I think the product development in that space has also been really interesting. And there's things now today that use laddered options instead of resetting options. And so you don't have to worry about that timing. So managed floor ETFs, structure protection ETFs, I think are a better mousetrap for that kind of core protection exposure. But my point being, even when you're in a risk-averse type of investment, there could be risks there that may not be fully understood when it comes to the impact on your portfolio.
So, you mentioned the addicted to growth. What happens when the market has to go to rehab?
I think it's going to hurt. We've talked to a lot of advisors on our side of Edify and some institutions. And even for institutions, they have a mandate to capture that growth. They just have to manage that risk. So to Daniel's point earlier, that everybody jumping on this wagon of growth for growth's sake, at some point the music could stop. The problem is, Eben, is that how many years have we been talking about the music stopping? And so the longer we say, recession is coming, market downturn, correction, and then the next thing we know, NVIDIA is up another 20% and the Mag 7 go crazy, it gets harder and harder to believe. So I think it's the difference between, yesterday I was reading a commentary about the difference between preparation and planning. And there's this guy I follow on Twitter, Sahil Bloom, And he's talking about how when you're planning for something, you actually know the conditions and you have an expected outcome. Preparation is you don't know what comes next. And so you have to prepare your portfolio for any possibility versus you're planning for a specific outcome. So I think this is the time to prepare. I think we're seeing some investors do that. We've seen a lot of flows go into the areas of the market that are not your high beta, that are not your large cap growth, that are not your meme coins. So I think investors are starting to get concerned, but market gains are it's FOMO. So we'll see what happens.
Daniel, what have you got to say about the situation we're in where people are concerned, yet it keeps going up, and people are losing, in some cases, losing their concern because it just keeps going up a lot?
Yeah, I mean, it's recency bias 101, and I think it's what you've seen. There's as we continue to have good year after good year, the emotional resonance of past bad years starts to fade. We start to forget, and we start to deviate from our rules. That's one of the things that we know about positive emotional states, is that they cause us to deviate from our rules. There's all kinds of interesting assessments of this, but it shows again and again. That's one of the biggest things about being happy, being euphoric, is that you become a stranger to your rules. And so it becomes harder and harder for folks like us to say, stick to the process, follow the rules, when being sort of wild and free has yielded such incredible results for some people. I think we have to speak to both sides of the coin, though, because for each of these investment alternatives that we're talking about today that's so sort of harebrained and risky, there's at least as many people who get hurt as there are people who profit. The stories of overnight success, though, tend to win the day. So it's a hard thing because of recency bias to be preaching this stick to your knitting, follow the rules thing that feels kind of boomerish and outdated in our sort of in our meme coin milieu that we find ourselves in.
Yeah, I mean, I think that we find ourselves so deeply in narrative world, and with the presumed change in the SEC for faster approval of new products, combined with AI, tokenization, and social credit, we're going to have a bunch of things that no one understands hitting the market. And it'll take a while for those to play out, and some of them fall apart. But the narrative is everything, and the fundamentals have become too hard to understand, if there are any at all. Phil.
Okay, I'm going to surprise everyone with my first choice, I think, which is the long-term treasury. In terms of I'll explain why in a second. So last year, on an after inflation adjusted basis, TLT, the 20 plus year long-term treasury ETF lost 10% after inflation. But if you look back in 2022, it produced an after inflation return of negative 36. In 2023, it was down 6.6 after inflation. So we add up the total return on an after inflation basis. In the last 3 years, it's down 46%. Now that's at a time when we just see, as we all know, the S&P 500 over the last 2 years at least going up 25%. So on a relative basis, it's almost harder to get crushed in legitimate investment than the 30-year. And guess what? So here's a factoid. At the beginning of 2022, the yield that people were clamoring for in the 30-year treasury to get that negative 50% loss, 2%. So you're starting with a yield of 2%. You lose 50%. Here's why I wanted to call out that. Because what happens is along this term of the corona bias, which is things that happened so long ago that we don't prepare for them, No one's thinking about the fact that between 45 and 81, there was a 36-year bear market in bonds. And I think we have to ask ourselves a question in the advisory community: is it over? With the prospect of tariffs, with all this growth, with potential tax cuts, does inflation reemerge? Do we see interest rates move even higher? Does this continue? Does it become even a worse story? And I would guess that most advisors that are listening to this still have this mindset of bonds are the stabilizing factor in my portfolio. Do we need to call that into question? That's why I wanted to bring that one up. The second one is along the lines of what you were talking about, Cynthia, which is the leveraged ETF, but a special call out here. I've seen over the course of the last 7 years or so, leveraged funds and ETFs come out, but their story is not get more growth. Their story is we're going to limit growth. These are the hedged equity tactical positions in portfolios. Here's why that's so bad. What people don't understand, one of the reasons stocks have worked so well is because this incredible power of return to the mean, right? So no matter how bad things get, if companies manage to have some earnings and growth over time, the economy recovers and it returns back. What leverage does is it potentially eliminates that possibility. If you have as a part of your strategy a 3x leveraged ETF, and that thing moves down 33%, it's called liquidation. It's a liquidation of that strategy. You could have a liquidation of a 3x ETF. It can happen. That means, so liquidity is good. All of these other things about, things being liquid are awesome. Liquidation, bad word. So you could have vaporized assets and that cannot return to the mean. That's a huge problem. And it's a bigger problem because I think if someone's going in leveraged NVIDIA, they probably know what they're getting into. It may be someone who's actively trading it. It's fine. But if you're going into something that's leveraged, that is poised as being your loss avoidance piece of your portfolio, it's probably Grandpa Arnold and Grandma Martha who are in there thinking this is actually the loss avoidance piece. Watch out. The third, I'm going to just join the party here, but I want to broaden it a little bit and just talk about all cryptocurrencies, but in particular, again, these ETFs and the fact that people can now play and advisors may be forced to get in there. I've been pounding our investment team to try to come up with an ETF that I would call the Bitcoin blow-up ETF. And what it would do is it would participate in ETFs, but they would have options in there that would gain 3x once it falls 20 or 30%. It's not possible. There's not the volume there in the derivatives, and the cost of those options are so high that it just doesn't work. But I want to pose this question, and I think this goes to the heart of what we're doing with Nerd Day, which is that if you look at cryptocurrency now, it's got a total market cap of call it 3.8 trillion. So we were at a high before of 3 trillion, which is bigger than any GDP of any country except the top three. Where does it go from here? And, in terms of thinking about where we are in this cycle of bubble, in the internet bubble, it was considered crazy to be investing in these companies that had no earnings or just a PowerPoint, right? And have it go up to billions of dollars. In the real estate bubble, it was like houses inflating unrealistically and people without incomes funding them. But I would ask this question to the panel, like, where are we right now? Like in terms of crazy, are we further out on the crazy spectrum than we've ever been in terms of the things that we're seeing people buy? And also, right now we're at peak to booked price to book ratio on the S&P, but we haven't really seen that blow off the top bubble like we saw in March of 2000. But is it happening? Or is the money on the bubble assets just going to other places? In the Great Depression, what caused the Great Depression to be so severe is banks just disappeared. They went insolvent and people just had their money vaporized. Is it any different now if we see cryptocurrencies inflate up to 5, 10 trillion, 20 trillion, and then we see that disappear? Is that the same kind of an effect on the economy as we saw during the Great Depression when banks dissolved? I've been talking too long, but I'm just like, I just wonder if this is a moment in time when we'll look back and say, gosh, we used to talk about tulip bulbs, but at least you got a flower then. But that was nothing compared to where we are now. And if we just really allow us to synthesize what's going on, is this a time for maybe moderate levels of alarm in terms of thinking about portfolios and risks to the broader economy and portfolios.
What do you think?
I'm sure Daniel has something much more brilliant to say. So, but I'll let him have the last word on that. But if you think about, is this the top kind of idea? If you think about market cap globally, in between the 80s and today, it's grown. I think I was looking at the numbers last week, like 4,400%. So in terms of total global market cap, it's a huge number. Over $110 trillion in global market cap today. In the 80s, I'm sure that was unthinkable. Today, that's the number we're at. So I always struggle with, is this the top on anything? Because I feel like we're constantly finding out that the top is always higher, just as the bottom is often deeper than we anticipate. So, I have no idea whether this is the top or a concern. On, the crypto craze, if crypto completely imploded today and disappeared, I think there'd be a lot of people hurt really bad, but would it really impact the economy? I'm not sure it would. I'm not sure that it is integral enough yet. Now, if you think about the technology associated with the crypto space and you talk about the blockchain, tokenization, all these other things, maybe as that gets more ingrained, then we're talking about, potentially a systemic risk here. But I think it's still too early days to have that kind of negative impact.
Cynthia, I think that
potentially could.
Yeah. I think that the question I have is that, because we already saw 3 trillion go to 1.5 trillion and the economy survived that, right? Mm-hmm. I think that the concern I have is that with the enthusiasm around this and the easier access, does it become 10 trillion? Does it become 20 trillion? Does it become the systemic risk just based on the hype around the I'm not going to call it an asset class, but just the thing that people can invest in. That's kind of what I'm looking at.
Yeah, I mean, if we're based that on the recent past, I mean, why? There's no reason to think it wouldn't get to that kind of size. I mean, the fast growth we've seen, we have no reason to expect it to stop, especially now as, SEC, the new change, they're going to have a whole, team now just looking into that, is about making crypto faster growing and more accessible, regulatory support, clarity, whatever clarity means in the crypto space. So there's no reason for us to believe that it wouldn't continue to grow at the pace it has. And anything that gets that big, once it falls, if it falls, I mean, it doesn't fall quietly. So it'd be interesting to see.
Yeah, Phil, I think we kind of have to throw out all the old maps with this, back to your original thoughts on the corona bias and sort of unknown unknowns. Every other asset class in history, even something as trivial as a tulip bulb, has had some sort of fundamental basis at its core, which eventually over time we moved away, like in the tech bubble, from worrying about eyeballs and clicks, and we got back to, price to earnings and price to sales and price to book type considerations. And there was this reversion to the mean. When you're talking about something like crypto that is undergirded by collective belief and human narrative, it's not clear to me that there is any limit to where that goes. And, I think at every point along the way, folks have tried to apply the old maps to crypto, and they just haven't fit, because in some ways it really is undergirded by our collective belief in it. And I think every day that crypto remains relevant, and heaven knows it's relevant today, it becomes more and more Lindy, and it becomes more and more stable. So I try to approach it with a mind of sort of curiosity and awe and befuddlement, because I tried for a long time to sort of apply old sort of traditional econometric maps to thinking about the price of cryptocurrency, and time again I got proven wrong. So I'm I'm just along for the ride, and I'm just enjoying it as a psychologist from the outside looking in. I couldn't have less of an idea of where it's going to go. But I do think, even now, it's hard for $4 trillion of value in anything to take a substantial hit and not have a hit to the wealth effect, to not have a hit to the real economy. So I think it is and increasingly will become a bigger and bigger part of conversations about the real economy.
Well said. That seems like a great place to leave this. Like, this was a fascinating conversation. I really appreciate. Well, actually, are there any further comments? Okay. You just shut it down, Daniel. Nicely done. That was perfect.
Well, Daniel was the kind to drop the mic, so he just did that.
That's great.
But I would just say, Evan, and actually that's for you. Like, I guess as we think about investment risk, there are good ways to manage risk. And I think what you guys are doing, at least in the ETF space, is an excellent example of that. So I just wanted to open the door for you there to say, there are great ways to invest and consider risk. And I think what you guys bring to the table is really smart.
Thank you, Cynthia. And now I don't have to say it because you just said it perfectly. Thank you. It's an honor to get to spend this 45 minutes with you. And I think the world of you all personally and professionally. And I very much appreciate you coming on and celebrating NIRD with us. And to all of you tuning in, happy NIRD. Take care.
Happy NIRD.